GLS tutorials. In our previous tutorial, we look at step acquisition part 1. Today, I want us to look at part 2. But in the part 2, we are going to do practice questions. We are going to pick questions and look at how we deal with issues relating to step acquisition. But before we proceed, I will always say that if you're watching any of our tutorials, check the comment section. The question that we are going to solve during the tutorial, the link to the question will be in the comment section. So check the comment section, click on the link and download the question. The questions are plenty. We solve some and list some for you. We are picking question 1. And the question 1 says that A acquired 10% of the equity share of B for 18,000 on January 1, 2016 and classified the investment as fair value through other comprehensive income in accordance with IFRS 9. At 31 December 2016, the fair value of the 10% investment in B was 24,000, and this was reflected in A's statement of financial position, resulting in a gain of 6,000 being recorded in other components of equity. On 1st June 2017, A acquires a further 50% of B's equity shares for 160,000. At this day, the fair value of the original 10% share in investment was 28,000. The fair value of the net asset of B was 200,000, and the fair value of non-controlling interest was 100,000. It is group policy to measure non-controlling interest at fair value at the date of acquisition. Required. Explain how the above transaction will be accounted for on June 1, 2017, the date that A achieved control over B, and calculate goodwill arising on the acquisition. So what we said is that for non-control to control, calculation or consolidation, calculation of goodwill and consolidation start from the day that the parent gained control over the subsidiary. So if you look at the question, the parent was initially having 10%. The parent was initially having 10%. So this was the information given to us. Okay. The initial investment was 18,000, but on 31st December 2016, this has now increased to 24,000. And the gain of this between the 6,000 was reflected in the financial statement of A. But on June 1st, 2017, A acquires a further 50%. So now A will be having percentage of 60. A will now be having 60% of the equity shares of B. In this case, A has now gained control over B. So A gained control over B on June 1, 2017. And consolidation and calculation of goodwill will start from this date, the day that control is being gained. So what was the value of the initial investment? It was 24,000. 24,000. But the day that the 50% shares was acquired, this has now increased to 28,000. What is happening? We are having a gain of 4,000 here. All right. So first of all, we have to know our purchase consideration. How can we calculate the purchase consideration? The purchase consideration will be the fair value of the initial investment, fair value, which is now 28,000. So we use the fair value at the day that control is gained, not the previous one. So we look for our additional acquisition, which is the value paid. The value paid was 160,000. So we are going to have 188,000 as a purchase consideration. And what will be the portion of the net asset that was bought by A? The portion will be the net asset the net asset will be this net asset is 100%. B is buying what? 60. So the remaining 40 is 100,000. So we can say that the portion that A is buying is 200,000 minus the NCI, which is also what? 100,000. So we can see that we are buying 100,000, but we are paying what? 188,000. There is something that we are not seeing, but we are paying for it, and that is what we call goodwill. So this is how we calculate the goodwill. Someone can also calculate the goodwill like this. The person will add the 100,000, which is the NCI, to the purchase consideration, and then subtract all the net assets from the figure. So the person will add 100,000 to this one to get 288,000. Then the person will now subtract what? 200,000 from it and get this one. This 200,000, the total value of the net asset of the B. But 100,000 out of this 100,000 is for the NCM, what we are not controlling, the share, the part of the shares that we are not controlling. So which share are we controlling? It will be the 100,000 from the total value, which is this 100,000 is for those we are not controlling. But the total value is 200,000. So just take those that we are not controlling for the total value, then you get the portion that you have paid for. So this is how we calculate the goodwill. This is how we calculate the goodwill. But what happens to the initial investments? The initial investments, the gain on initial investment, the gain on the initial investment to be calculated as what is the fair value, fair value, fair value at June 1, 2017. The fair value was 24,000. Was 24,000. At the time that we acquired additional shares, what is now the fair value? The fair value now, the new fair value, let's name it the new fair value, is now 28,000. It's now 28,000. So what is happening? There is an increase in value of what? 4,000. And this one, if you're preparing profit and loss accounts, you send this one to the profit and loss account relative to 2017. But if you're preparing statement of financial position, then you add this gain to return earnings. You add it to return what? Earnings. You add it to return earnings. You add it to return earnings. But what happens to the old 6,000 that is in the other component of equity? First, we used to reclassify the gain, but right now, IFRS 9 says that investment in equity shares, the gain cannot be reclassified. But if it should be a debt instrument, then we now, because we have now assumed that the initial 10% has been sold, so therefore, this gain over here will be realized. Then we reclassify this one to our return earnings. But this is investment in equity instruments. So if you are doing investment in equity instrument, whether the instrument is being sold or the instrument is being reclassified, we don't reclassify the gain. So this gain will still be in what? Other components of equity. But if it should be a debt instrument, since we assume that we have sold the 10% and still bought it, we are going to reclassify this one to return earnings. But this is investment in equity shares, so we don't reclassify investment in equity shares. We do that for only debt instruments. So this is all about the question. This gain will go to return earnings. So the thing is, for you to tackle this question, first of all, you have to know the value of the initial investment and the day that control is gain. Compare it with the new value. If there is any gain or any loss, send it to return earnings. Or if you're preparing profit and loss account, show it as a gain or loss in the statement of profit or loss and other comprehensive income. And you will now come and determine your purchase consideration. The purchase consideration is now the new fair value of the initial investment plus the additional consideration that you pay for the additional shares that you acquired. Then you either add the NCI to it, then you subtract the total value of your net asset, then you get your what? Goodwill. That is how we do it. But we are saying that for investment in equity shares, whether the investment is being reclassified or being disposed of, we don't reclassify the gain, the initial gain or the previous gain on that particular investment in profit and loss. We don't reclassify the gain to profit and loss. But if it is for debt instrument, we reclassify the gain to what? Retained earnings or profit and loss account. So this is basically about this question. So first, you have to know the gain on your initial investment by looking at the fair value at starting and the new fair value. Then you calculate it. You determine your purchase consolidation. Then you do it and calculate your goodwill. So this is all about this particular question. I'm picking question 3, and this one is on control to control. This is from control to control. So if you look at the question very well, you see that Gordon has owned 80% of Mandy shares, but Gordon acquired additional shares of 10% for 50,000. But the NCF for Mandy at acquisition was 100,000. And the net asset at acquisition was what? 300,000. And net asset at the date of acquisition of the additional shares was 400,000. We say that whenever the parent has control, before the parent acquire additional shares, we say that the parent is buying part of the NCS shares. Because the parent is having 80%, it means that NCL will be having 20%. So the parent acquire additional 10%. It means that the parent is buying the 10% out of the 20% that is for the NCL. So what we normally do is that we look at the portion of the shares that the parent is buying, the proportion, what proportion of the NCL are they buying, and how much is the parent giving out, what is the consideration the parent is giving us for the shares. We calculate the two. Then if any difference, we send it to other component of equity. So the first thing is we need to know our NCI at the date of the acquisition of what? Additional shares. So what we need to do is that we need to find our NCI. But NCI at acquisition, the question says that NCI at acquisition, NCI at acquisition, NCI at acquisition is what? 100,000. The only thing that can cause increase in NCI is the post-acquisition profits. And the only thing that can cause increase in the net asset will also be the post-acquisition profit. Sometimes it can be revaluation, but we all classify all of them as post-acquisition profit. So the net asset at acquisition was 300,000. But the net asset at the date of acquisition of additional shares is now 400,000. So we can say that there was a post-acquisition profit of 100,000, which is the difference between the 400,000 and the 300,000. So this post-acquisition profit, which is the 100,000, what will be the NCS share? NCS share will be 20%. So we need to find the post-acquisition profit, share of post-acquisition profit, which is 400,000 minus 300,000 times 0.2, which is the 20%. So what will be the NCS share of that one? The NCS share so NCS will be taking 20,000. So the total value of the NCI at the acquisition at the date of acquiring the additional 10% will be 120,000, and this represents 20%. So the parent is now buying 10% out of this. So for us to know the proportion of what the parent is buying, the portion of the NCI that the parent is buying will be the 10% over 20, because the 120 is for what? Is for the NCI, which is 20%, times 120,000. So we put our currency sign here, and that will give us That will give us 60,000. That will give us 60,000. So this is a portion that the parent will be buying. The parent will be taking for the NCI. But how much is the parent paying for this? So what will be the purchase consideration? What is the purchase consideration? The purchase consideration is the parent is paying 50,000 for this. What is happening? The parent is getting more than what they are paying. So what will be the difference here? The difference over here will be 10,000, which will be sent to other components of equity. So after the transaction, what will be the NCI value? After the transaction, the NCI will be, after the transaction, the new value of NCI, non-controlling interest, the new value of NCI, the new value of NCI will be, let's assume that balance go down, which will be 120,000. Then we have disposal, which is the 10%, which is now the 60,000. So the NCF value after the transaction or after the acquisition of the 10% is now what? 60,000. So this is how we solve control to control question. This is just an illustration. We take a whole question and we look at this. The first thing that we are saying is that we need to know the NCI share at the day that the parent is buying the additional shares. So the NCI was 100,000 acquisition. The net asset was 300,000, but the net asset at the date of acquiring the additional shares was 400,000. So there was a post-acquisition profit of 100,000. So the NCI will take 20%, which is each share of the post-acquisition profit. So the NCI will now be the NCI at acquisition 100,000 plus the 20,000, which is the post-acquisition share of the profit. NCI will now be 120,000, and this represents 20% because the NCI is 20%. So the parent is buying 10% of this. This is for 20%. So what will be for 10%? It will be 10 over 20 times the NCI value, which is 60,000. But the parent is paying 50,000 for this. So the parent is what? Paying less than what is or what they are receiving. So the difference, whether negative or positive, we send it to other components of equity. So after that, you have to come and ascertain your new value of NCI, which will be 120 minus 60,000. This is all about this question. We are going to pick a major question or a question or complex question. Then we look at how to deal with issues relating to step acquisition, either being non-control to control or from control to what? Control. In question 7 from the question bank, and the question 7 is question relating to A, B, and C, D. So the statement of financial position for A, B, and C, D as at 30th June 2012 are provided below. So you can see the figures there. Let's move on directly to additional information. A, B acquired a 10% investment in C, D on February 1, 2009 for 800,000 Ghana cedis. The investment was classified as fair value through other comprehensive income with any associated gains or losses recorded within other components of equity in A, B's individual financial statements. So the B, on 1st January 2012, AB acquired an additional 60% of the equity share capital of CD at a cost of 51. So you can see from the question that AB achieved control over CD on 1st January 2012. So from this date, it is from this date that we are going to consolidate the financial statement. It is from this date that we are going to calculate our goodwill. So the first thing is that the first calculation that we have to do is that we have to draw our group structure. So we have to draw our group structure, or since it will be group that we have the parent and then the subsidiary, let's come and put our assets here. So this will be the PPE, property, plant and equipment, will be 58,000 plus 8,500. Okay. The investment will now be cancelled. Then we come to current assets. The current assets, we have inventories. We have inventories, which we put a figure there, 15,500 plus 2,000. So the first thing that we have to do is that since this is statement of financial position, just come and add the figures before you go and do your workings. Just come and add your figures. We are going to consolidate an account. So for statement of financial position, we don't prorata the items because this is a financial statement. They are going to do it as if this thing was done from the beginning of the year. So we come here, we just add our items here. We have receivables. We have receivables to be 16,500 plus 4750. Then we come to cash and cash equivalent. Cash and cash equivalent. Cash and cash equivalent. Cash and cash equivalent will be 3,000 plus 750. Then we have our total assets. We come to equity. We come to equity and liabilities. Equity and liabilities. Then we have share capital. Share capital of, that is for AB, is 50,000. The retained earnings, we are going to do workings for it. Retained earnings, we are going to do workings for it. Okay, I don't have enough space, so I'll be erasing what I'm doing the workings. So the first working is the group structure. The group structure. So what will be the group structure? We have the parent, which is the AB, and we have the subsidiary, which is the CD. The control is now 10% plus 60%. So it will be 70% NCI will be 30%. So we have NCI to be 30, and we have this one to be this one. And acquisition date is January 1, 2012. What is the reporting date? Reporting date is June 30th, 2012. So post-acquisition period is 6 months. Post-acquisition period is 6 months. So the next one is that we have to look for how much is the parent paying for the 70% shares of the subsidiary, and what is the portion that the parent is receiving in return. Any difference will be seen as what? Bargain or bargain purchase or goodwill. So let's look for that one. We can only do this by preparing our net asset table. Table. So let's go with our net asset table, which is workings 1, workings 2. Net assets. So the net assets we have at acquisition, at reporting. Then we have post acquisition profits. So our currency sign is Ghana cedis. 3 at the top, 3 at the top, 3 at the top. All right. So we look at net asset. Net asset we calculate it from the liability side. We use the shares. So So we have our share capital, which is the equity shares of the subsidiary is equity shares of the subsidiary is 2,500. This will be similar to 2,500 dash. What's next? We have the retained earnings. What is the retained earnings? So what we are going to have is that this is a mid-year acquisition. So the retained earnings over there, which is a 6,500, includes the profit for this year. What is the profit for the year? If you take the question very well, if you look at additional information E, the profit for the year for the subsidiary, which is the CD, is 2,000. The profit for the year is 2,500. But this was from April to June. This was from not April. This was from July to June. But when did the parent acquire, or when did the parent gain control over this? The parent gained control on January, which is half a year. So we divide this one by 2, we get 1250. Then our return earnings at acquisition will now be 6,500, which is the overall return earnings over there minus 650. So we have 6,500 minus 1,250, and this will give us 5250. And our reporting will be 6,500. This will give us post acquisition profit of 1250, which is the 6 months. Let's come to the next item. The next item over there is other components of equity, but the subsidiary don't have any. So let's go to additional information to see whether we can have any fair value adjustments. If we take the requirement B, there is nothing over there. Let's take C. At 1st January 2012, the fair value of the net assets acquired was assessed to be the same as their carrying value, with one exception. Property, plant, and equipment. Property, plant, property with a carrying value of 3,200 had a fair value of 4,000. What is happening? We can see that at acquisition, a property with a carrying value of 3,200 has increased by 800, which is now the 4,000. So what will happen? We have a fair value adjustment, which is fair value adjustment, which is property, and at acquisition is 800. At reporting to it will be 800. Then we have dash here. What will happen? This will now increase our PP. So we come and add it to PP over here. So this will now increase our PP. Alright, let's move on. The remaining useful life of this asset is 10 years from the date of acquisition. So the remaining useful life of this asset is 10 years from the date of acquisition. So from January 2012, the asset has a remaining useful life of what? 10 years. But from January to June is 6 months. So what are we going to happen? What is going to happen? It means that the subsidiary was depreciating the asset based on 3,200. Meanwhile, it should be what? 4,000. So the excess is 800. And that excess is also bringing an additional what? Depreciation. So we have to calculate that depreciation and see how we do about it. So the depreciation will be, additional depreciation will be 800 over 10 times 6 over 12, which is half a year. Because this is half a year. From January to June is what? Half a year. And they say the asset is having a remaining useful life of 10 years from the date of acquisition. From the date of acquisition to the reporting date is 6 months. So this will give us, this and this will cancel, 80 times 0.5. This will give us 40. So if we come here, we have excess depreciation. Excess depreciation. This excess depreciation, have to be subtracted from the profit for the year, but they haven't included this a fair value adjustment. So we are now doing it. So we have 40 here, and this will also give us 40 here. Now what will happen? We have to reduce the value of the asset by what? 40. That's how we do it. Let's move further. Moving further, we are going to have depreciation on PPE is charged on monthly straight line basis. So we have done a depreciation which is 800, give additional depreciation which is 800 over 10 times 0.5. That will give us 40. We have done that already. Is there any adjustment on that one again? Let's read to the question and see. Okay, let's look at this. Let's look at this. Okay. CD sold goods to AB for 10,000, for 100,000, no, for 1 million, 1 million Ghana cedis. Half of these goods remain in inventory at 30th June 2017. CD earns 25 margin on all sales. So after acquisition, CD, which is a subsidiary, sold goods to the parent for 1 million, and half of these goods remain in stock. If half of these goods remain in stock, it means that 500,000 of these goods are still in the inventory of AB, and CD earns a profit margin of 25% on all sales. So the first thing that we have to do is that there will be a portion of the profit on 1 million goods which will not be realized. So we have to calculate for the realized profit. But first, let's take this one first. Let me take this one. Now can I have my provision for realized profit? This will give us 1 over 2 times 1 million thousand times 0.25, which is a 25%. So this will give us 500,000 Ghana cedis times 0.25. We are already giving margin. If it should have been markup, then we change the markup to margin. So this will give us 500,000 times 0.25. 500,000 times 0.25. Times 0.25. That will give us 125,000. So 125,000 of this of the profit will not be realized. So what will happen? This is supposed to reduce the profit of CD. So we come and subtract that one for the profit of CD. But this will also, the parent is now carrying the inventory at fair value, which should have been cost. So we come and subtract 125 from here, and we also subtract 125 from the net asset of the subsidiary, which will be provision for unrealized profits. At acquisition, we are not going to do anything. At reporting, this will be minus 125. Minus 125. Okay. So let's total this. I don't think there is any other adjustment to the net assets. If you total this, net assets at acquisition will be 8550. What about at reporting? At reporting, we are going to have 2,500. This will give us 96. I don't have space here. This will give us 96.35. Let's find a difference. The difference will give you, the difference is 1085, which is a post acquisition profit. So we can now calculate our goodwill. We can now calculate our goodwill. So we can now calculate our goodwill, which is working stay goodwill. So goodwill is calculated as a purchase consideration. What is the purchase consideration? Purchase consideration is the fair value of the initial investment, which is now 1 million, which is 1,000, because we are keeping three zeros, plus 5,175, which will give us 6,175. What is the net asset here? Net asset is what? 8,550. But what is the parent is having only 70% of this, 30%. What is the remaining 30%? The remaining 30% is the group policy to value non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest at 1st January 2012 was 2,700. So if you like, you can add the 2,700 to this one and then I subtract this one. If you also like, you can also see the net asset to be 8,550 minus 2,700, which is the NCI. So if you subtract this from the total, the remaining will be for what the parent is buying. So let's look at what the parent is buying. 8,550 minus 2,700. This will give us 50. This will give us 5,850. 5,850. So the, the value that the parent is buying is 5,850. How much is the parent paying? The parent is paying 6,175. You can see that the parent is paying more for something that is not there, which we technically call goodwill. So 6,175. We are going to have a goodwill of 325. This is goodwill at acquisition. Goodwill at acquisition. Goodwill at acquisition. Goodwill at acquisition. That is goodwill at acquisition. Goodwill at acquisition. The goodwill, there is no impairment on goodwill. So we come here, we put our goodwill here. We put our goodwill here, which is working strength. Our goodwill will be 325. That is our goodwill. 325. Okay, that is our goodwill. Then we go to the workings for we go to the workings for we go to the workings for okay, we go to the workings for our NCI. We go to the workings for our NCI. So our NCI acquisition is 2,700. What was the post-acquisition profit? Post-acquisition profit, share of post-acquisition profit will give us the NCA is having 30%, so 0.3, and the post-acquisition profit. Post-acquisition profit was 1085. 1085. So NCA will be having 325.5. 325.5 plus 2,700. That will give us 3025.5. So we come to the group return earnings. We come to the group return earnings. NS. So we have the parents retain NS, which is from the question the parent retain NS is 8 18,795. Share of post acquisition profit is 0.7 times 1085. 759.5. So what will happen? We look at the initial investment. The initial investment was 800, but at the date of control, it is now what? 1,000. There is a gain of 200. But what happened? This gain will be sent to retain earnings. But if you look at the other component of equity, they have 1025 as a figure for the parents. But if you look at the cost of the investment, it was 800 first plus 575, 5175, which will give us 5975. But if you look at the investment of the parent in the subsidiary, it is 7,000. So you can see that the difference is 1025. So the parent was carrying this one at fair value. But in actual sense, it should not be fair value because we are consolidating. So what will happen? We go and what? Cancel this. So by canceling this, what we do is that we now use our 5175 in the calculation of our goodwill, which will reduce this one, because the parent is thinking that this is now plus 1025 plus this one. So if you use 5175 only, it means that we technically cancel this one out. So after using the 5175, we are cancel the other component of equity. So what will happen? The gain on initial investment will now be 1,000 minus 800, which is 200. So that will be for the gain. We remeasure the gain. We remeasure the initial investment, and that is the gain. Let's see whether there's something that will go to. Let's see whether there is something that will go to the return earnings of the parent again. There is nothing over there. So we just put together the return earnings of the parent. 18,795 plus we have 19,754.5. This is the return earnings of the parent. This is the group return earnings. So if you come here, you just have to add these figures. So we have 5,800 plus 8,500 plus 800 minus 40. This will give us 67,260. So let's add this. 325. We have 67,585. So if you come here, we add this. This will give us 3750. 16,500 plus 4750. This will give us 21,250. 15,500 plus 2,000 minus 125 17375. So if you put all of them together, we are going to have 10,9960. This is our total assets. Total assets. Our retained earnings, which is working, is retained earnings, which is working, is 5 is, so this one is 50,000. Retained earnings is 19,754.5. Other component of equity will be cancelled because we are using the actual figures. So when we are using the actual figures, it means that it will be cancelled out. So we will now have our total here, total this one. Then we have 50,000 plus 19,754.5. This will give us 69,754.5. Then we have our NCI, which is working for to be 30,25.5. Okay. And let's come here. Our non-current liabilities is 9750 plus 2,000, which will give us 11750. Then we come to current liabilities. Current liabilities to be 20,250 plus 5,000. This will give us 25,250. So if we add all, what are we going to have? We add what are we going to have? Plus. So then we add the equity and then the NCI. 30 to 5.5. Alright. Seems like our return earnings displays the figures. So the parent return earnings was 18,975, not 18,795. So we add the share of the post-acquisition profit, which is 759.5. And we add again on initial investment, which is 1,000 minus 800. So this will give us 200. So the new value, this will give us 9934.5. So this is our new return earnings. So I wrote 18,795 instead of 18,975. So that was a mistake there. So this will also come here and we put our new figure here. This will now be 934.5. And the total is now Now 69934.5. Add our NCI to it. Then we have our total will give us we are going to have 72960. Then we add these figures to it plus 11750 plus 25250. Then we have 109960. This will give us our total equity and liabilities. Total equity and liabilities. So this is basically about this question. But the next question over there. So the next question over there is saying that AB purchased a further 10% of ordinary share capital of CD on July 1, 2012 for 1172 Ghana cedis. Explain how the acquisition of his additional investment will be accounted for. Prepare the journal entry that records the purchase of additional this one. So this one, we say that on this date, when the parent buy after control and the parent buy additional shares, we say that the parent is buying additional share or portion of the NCI. So the parent bought the additional shares on July 1, 2012. That is the beginning of the next accounting period. So the first thing is what was the NCI at that date? The NCI was 3025.5. So this represents 30%. So the parent is buying 10% of that. The parent is buying 10% of that. The parent is buying 10% of that. So the portion that the parent will be having is 10 over 30, which is the 30% for this one, times that figure, which is 500, because we are keeping 3 zeros. So what will be the figure for the parent? What will be the figure for parents? 10 over 30 times 10 over 30 times 30 to 500. 30 to 500. Okay. The parent will be having 10118500. This is the figure that the parent is buying out of the NCI. This is the figure that the parent is buying out of the NCI. So the parent is buying this out of the NCI. The parent is taking this out of the NCI. It's having. So the portion of the NCI that the parent is, the portion of NCI that the parent is buying is there. 108,500. How much is the parent paying for this? The consideration. What is the consideration? What is the consideration? The consideration is 1172,000. So what is happening? Is the parent paying more? The parent paying more? Yes. The parent is paying more. The parent is paying more. So the parent is paying 163,500 in excess. So this will go to other component of equity. So they say we should prepare the journal entry. The journal entry is now debit NCI with 1 million 1,008,500. Then we debit other component of equity with 167,500. Then we credit cash or bank. We credit cash or bank with 1,172,000. So this is the journal entry. You can see that the parent is paying more for this one. We should have just go and write this one off against what? Return earnings, because the parent is paying more. That is an expense or that is a loss. But the standard says that we should take it to other components of equity. So this is basically about this question. In our next tutorial, we will take a question on profit and loss account and we solve it.